Hello, this is Corner Invest. Today I'll be talking about my largest position that just smashed its earnings. So this stock position is none other than Google. So in today's video, we'll be covering a few things. We'll be covering Google's earnings, what this means for Amazon as well as Microsoft, as well as some questions that you guys have for some of the stocks that you guys are watching. So Google's earnings over here, Google increased revenues by 12% or 14% on a constant currency basis. I think it's incredible for this business. Google's services revenue increased by around 10%. Google's cloud revenue increased by 28%. Total operating income increased by 20%. That is incredible. Net income increased by 46%. EPS increased by 49%. And besides just pure growth, this company is also becoming a dividend growth stock. So they increased their dividend by around 5% all the way until 0.21 dollars per share. So this is Google's revenue breakdown over here. Google search is increasing by 10% year on year. So for a company that is facing existential threat to all your different LLMs, it is incredible for the business to grow 10% year on year. And I do believe that Google search will still remain dominant in this space because your LLMs, they are for different use cases and not primarily for searching up of consumer products, which is what Google has been promoting and what Google has been pushing over the few years. So Google YouTube also increased by around 10% from 8090 to 8927. So I think Google YouTube is an extremely underrated business. Why? Because Google YouTube has no innovation risk. It's just a platform. It's more of like a middleman. So what people do is they'll create videos and then they'll post it on there. And then Google YouTube, they don't have to go and put in money for production costs and all that. If you are to compare this to Netflix, for example, Netflix, they need to innovate, they need to go and pump money to create their own shows because they can't simply just buy someone else's show and then put it on there and then sell it to your consumers and all that, which is what YouTube can do. And that's why I think YouTube alone should be worth at least $500 billion already. So that is around 1/4 of Google's entire market cap today. Next portion is Google Network. Google Network is a small portion of the business. It is the ad mob and all that. So it had a decline this year, but it doesn't really matter too much. Google subscription is the incredible one. Google subscription increased from 8739 to 10379. So it's incredible growth as well. And then the main one that everyone is looking out for is your Google Cloud. Google Cloud increased by 28% from 9574 to 12260. On top of operating margin increase for Google Cloud, this portion of the business is also increasing revenue. That is just incredible. The AI story is still there for Google. And yeah, everyone discounting Google and making it like a commodity stock isn't really looking at the numbers right here. So next portion. So this is Google's breakdown of their revenue as well as the net income. Revenue grew by around 12% or 14% on a constant currency basis. For a company as big as Google already, the revenue growth is quite remarkable. So Amazon, for example, is growing revenues at around 10% only, whereas Google is growing revenues at 14% on a constant currency basis. Operating margin also increased from 32 to 34%. And the big one over here is the net income. Net income increased by around, I believe, 20% or 40% or so. It came in a lot above the analyst expectation. The analyst expected around $2 of EPS. Google came in at $2.81. But the majority of this EPS beat over here was because of this portion over here, which is the other income portion, where they realized some of the equity gain. So you have to discount that and find the actual adjusted EPS that they had this quarter. So this is Google's buybacks. Google has initiated a $70 billion buyback. I think this is incredible from the management because everyone was complaining about how the Wiz acquisition was going to hold back all the different buybacks as well as the capex. So them announcing this now is incredible because the stock is trading at a cheap valuation. It deserves at least a 24 times earnings. It is currently now trading at around 20 times earnings. I think for a business like Google, if it is trading that cheap, if it is trading so much cheaper than the actual markets, the markets are, for context, trading at around a 24 times earnings. So if you have Google trading at 20 times and the market trading at 24 times, there's no reason for you to not buy back your stock. And I think this is a good decision by management. It shows confidence in the actual stock price and not just funneling money into AI and funneling money into all your different acquisitions. So for the next portion over here, income from operations increased by around 20%. So just now there was the EPS increase. The EPS increase was around 49%. That was mainly because of the equity gain that they had and realized it. So next portion over here, I'll be talking about Google's operating leverage. So Google has incredible operating leverage. If you're to look at the main metric that I look at as well, which is your operating margin, for a business as big as Google already, it is still able to increase its operating margin over time. This is just incredible. And your revenue is growing much faster than the cost. That is why you're seeing your operating income growing by 20% or so. And for me, I think Google it's a stock that no one believes in, but the numbers clearly show that this business is incredible in all fronts. So this is Google's valuation right now, accounting for the equity gain. The EPS right now is around $8.22. This was what I calculated. If you don't account it for the equity gain, it's around $8.90. So with the stock price now overnight at around $170, this represents a 20.6 times earnings. I do believe that Google still has a lot of multiple expansion ahead, especially with the narrative changing now, with the numbers coming in. If the macro tailwinds come in, you could easily see this stock going back all the way up to 24 times earnings, which is where it is supposed to be trading at for a business as high quality as Google. And without adjustments, it is trading at around a 19 times earnings. So this is Google's hidden gem over here. The hidden gem is none other than Gemini. So Gemini is part of the subscription business over here. The subscription business increased by around 18% year on year. So they increased by around 18% year on year. Your Google subscription business includes your YouTube TV, your Gemini subscription, your Google Drive subscription, and all that. And for a recurring revenue business model like this subscription portion, I think it's great for the business, and it is one that no one is looking at, but starting to pay attention to it right now because it is around 10 billion of the total revenue over here. So this is Google's story. Sundar Pichai, he basically reaffirmed the capex in his earnings call. He sounded a lot more confident about capex, and although they cited that there will be earnings hit due to forex and your tariffs, overall the outlook for Google is still strong. Google and Sundar Pichai, he basically said that Google search is still strong and Google is growing in all fronts. So this is what it means for all your different other hyperscalers. So for Amazon over here, it is a strong company. It is the largest cloud and it is still strong. So this is from Google's earnings over here. They said that second, in cloud, we're in a tight demand and supply environment, and given that revenues are correlated with the timing of deployment of new capacity, we could see variability in Google cloud revenue growth depending on capacity deployment each quarter. We expect relatively higher capacity deployment towards the end of 2025. So Google and Sundar Pichai is basically saying that your cloud is still undersupplied. It is still over demanded. And I expect this trend to be the same for Amazon and Microsoft as well. So overall, this is bullish for all your different hyperscalers. This clearly shows that although the tariffs are coming in, companies are still needing the cloud services. Companies still need to shift their staff to all these cloud providing services. That's why you're seeing strong growth for both of them. So Azure will definitely be strong as well. Let's see what they report next week or in 2 weeks' time. So this is what I'm doing. I have a strong position in the hyperscalers already, and I'll be looking to increase my positions over the next few months. The recent dip has provided me with a decent opportunity for me to enter, although they are not very large yet. I would like for them to be around 10% each in my portfolio. Google may be slightly larger because it is an undervalued stock either ways. But overall, I think for your hyperscalers, they are the distributors of AI, they will win. It's like Cisco and YouTube back in the day. So I view Nvidia, for example, your chip making companies, as Cisco. They are the companies creating the chips to go and funnel all these different services. Whereas for YouTube and Netflix back in the day, they were the ones that used the Cisco telecom services to go and create all your different websites. For example, your YouTube, your Netflix.com and all that. So same thing over here. You have Nvidia creating the chips. And then I view the hyperscalers, Microsoft, Amazon, as well as Google. These three companies will be the winners because they'll be able to successfully use all the different chips and basically expand their services, expand their growth. And normally the distributors of AI is the one that wins, not so much the creator of AI. So next portion over here, I'll be answering some of the questions that you guys have on some certain stocks. So the first one is Nike, Zoom, Pfizer, and Google. So Google, I've just talked about it earlier already, is an incredible company. It's one of my largest positions in my portfolio. As for Pfizer, Pfizer is a stock that's in the pharmaceutical industry. And normally for the pharmaceutical industry, I usually avoid it simply because it is too hard for me to understand. So you have a lot of different variables. You have your patents, you have regulation, you have basically all the different growth trends in all these different drug segments over here. So for Pfizer, I think it's an avoid. It looks cheap because the stock has dropped around like 60-80% or so from all-time highs already. But for me, Pfizer is an avoid. Next one is Zoom. So Zoom, I think it provides a service that is highly commoditized. So you have other online meeting platforms as well. Like for example, you have your Microsoft Teams, you have Google with their Google Meet, you have Zoom with their own platform, as well as some other platforms from Salesforce as well, like your Slack and all that. So I think Zoom, they don't provide a very unique service. And for me, I think Zoom is an avoid. Although everyone still uses the word Zoom when they talk about online meeting, I don't think that Zoom is a company that is able to provide a differentiated product as compared to all your different other online meeting platforms. So for me, Zoom is an avoid. As for Nike over here, Nike is a company that is not vertically integrated yet. So the problem with Nike is they're extremely susceptible to all your different tariffs. simply because the company is not vertically integrated. So what they do is they have their shoes, and then they need to outsource those shoes to all your different other factories in, for example, Vietnam, China, and all that. And that is proving to be a problem, especially when the tariffs come in. So when your tariffs start coming in, then because Nike is not vertically integrated in the US, they don't have their own factories, they outsource all their products, then the cost of their goods will be extremely higher, which will eat into their margins over time. Next one, Nvidia. So Nvidia, as I said earlier, Nvidia I view as a commodity. So Nvidia, although is able to produce technologies that are better than all your different other chip making companies right now, you have competition in the form of Google, Amazon, Microsoft, all creating their own chips as well as Meta. And then you have other chip making companies like AMD as well creating their own chips. So I'm not too sure what Nvidia's IP is, whether or not they have it. So for me, I'm staying out of Nvidia. Although it looks cheap on the growth prospects right now, but for me, I prefer predictability rather than the growth itself. So for me, Nvidia is an avoid. Next stock is Netflix. So Netflix, I view it as the winner of the streaming game already. So you have other platforms like Amazon Prime, you have Disney, but no one is talking about competition from those two fronts already. Everyone is talking about how Netflix is going to win, which I do agree with. It's showing up in the numbers already. But for this stock over here, it is trading at a very hefty valuation, and that's why I'm avoiding this one. I view YouTube as a business that is superior as compared to Netflix. For me, Netflix is an avoid for now, but maybe if it drops cheap enough, it is definitely a high quality business already, but for me, I am avoiding this one. Last one is United Health. So United Health is a stock that I recently just increased my stake in. I just bought into this stock after its plunge, and for me, I view United Health as a fundamentally strong company that will just compound over time. So looking at the fundamentals itself, if you were to neglect basically 2024, where they had a cybersecurity attack, a one-time cybersecurity attack, I think this business is still very strong in all fronts. So this one-time lowering of guidance, they lower guidance by around 10% or so, and the stock dropped around 20-30% or so since the high already. So I don't view this as I view this as a one-time thing because they had the Luigi case last year, and then they had basically all the different regulations and all that that came in last year as well. So this Q1 could just be a slight blip in their earnings. And if you're to look at their competitors like Elevance Health so far, Elevance Health, they posted quite strong earnings. The Carelon service increased by around 37%. Their Anthem Health Services, which is their legacy insurance business, also increased quite substantially as well in terms of its revenue. So overall, I think United Health, it is able to increase revenue by around 10% or so. And if it can continue doing that, adding on to the buybacks and some margin expansion here and there, I think United Health is easily a 12 to 13% CAGR over the next few years or so. That's why I bought my stake into United Health a week back because it was trading at a discount. So hopefully you guys have found this one useful, and yeah, Google is here to stay, and please invest safe.